Today we're taking a look at an alternate version of exercise 7-11 from page 343 of the textbook on chapter 7, reporting and analyzing receivables. We're looking at a transaction on note receivable transactions. So the data shows prepared journal entries for the following transactions for Denisha Company for 2015 and 16. The 2015 transactions were actually those recorded from the earlier problem in 710. That wasn't assigned. We're really going to zoom in then on just the 2016 transactions. But we're going to go ahead and show, just for illustration purposes, the transactions from December 13th, 2015 and December 31st, 2015. So the journal entries to create those transactions would have been a note receivable for Mr. Lee of $20,000, getting rid of his old account receivable of $20,000. So he had an account receivable that he couldn't pay off in time, so it switched into a note receivable. And then on December 31st, to record the interest for that note as well. And that was interest receivable of $80, interest revenue for the period of $80 as well. So very, very similar to what we did in a previous exercise. Now we want to zoom in on the 2016 transactions. So on January the 27th, we received from Lee payment for the principal and interest on the note dated December 13th. So it was a 45-day note. 45 days have passed. January the 27th, time for it to be paid off. So we're going to receive cash. The note receivable of $20,000 is going to go away. Interest receivable, that's interest for the entire 18 days from December 13th to 31st that we accrued back on December 31st. That $80 is going to get paid off. Plus there's going to be 27 days more of interest that Mr. Lee also has to pay. So to calculate that additional interest cost, $20,000 times 8% times 27,360 gives us additional amount of interest of $120. So we simply add all that together, and the amount that Mr. Lee has to pay on January the 7th to pay off his note dated December 13th is $20,200. Let's move to our next transaction. On March the 3rd, we accepted a $14,000 8% 90-day note dated March the 3rd in granting a time extension on a past due account receivable for Thomas Company. So, like we saw with the earlier example for Lee, Thomas owes us a $14,000 account receivable. Receivables have a normal debit balance. To make that $14,000 debit balance go away, what are we going to do? We're going to give it a credit of $14,000. And now that offsetting entry is going to be the creation of this new note receivable for $14,000. Let's move on to our next example. March the 17th, note receivable H. Chang. It says they accepted a $12,000 30-day 7% note dated March the 17th and granting Hiroshio Chang a time extension on his past due account receivable. Wow, we've got a lot of customers that are not paying their receivables on time here. March the 17th, we're going to do a very similar transaction. Going to have a new note receivable for $12,000, and we're going to get rid of the old $12,000 account receivable balance. Moving on to our next transaction, April the 16th, Chang dishonors his note when presented for payment. Oh, somebody's not honest here. They're not going to pay the amount owed to them, so we have to charge that amount off. So the account receivable is going to get restored actually first. We're going to restore that account receivable for $12,000, get rid of the note receivable, and record the interest that he owed us for those 30 days of $70. $12,000 times 7% times 30 over 360. Remember, this was a 30-day note, so 30 days worth of interest is $70. So the entire amount that Mr. Chang owes us now is actually $12,070. Now, many companies would decide on that exact same time when the note was dishonored to go ahead and charge it off. In this case, the company is waiting to do this until May the 1st. So May 1st wrote off the Chang account against the allowance for doubtful accounts. So we're actually applying this full amount now back to that allowance amount we've been setting aside periodically for uncollectible accounts. So on May 1st, the entry is to use up part of the allowance. We're going to use up the allowance in the amount of the full account balance for Chang now that includes his interest of $12,070. So we're going to credit $12,070 to Mr. Chang's account to make his balance go to zero, and we're going to use up some of our allowance. Remember, the allowances have a normal credit balance. To use it up, we're going to debit it, and that transaction is to write off the balance for Mr. Chang. The last transactions on June 1st, we received the Thomas payment of principal and interest on the note dated March the 3rd, So we received cash. We received cash for the note plus the interest. We know how much the note was. The note was that $14,000 note that we started on March the 3rd. That was a debit balance. To make it go away, we give it a credit entry. We have to calculate how much interest is due on that note. Let's see, this note was dated March the 3rd. It was a 90-day note, so 90 days worth of interest is going to be calculated. So $14,000 times the note interest rate of 8% times 90 over 360 gives us the total amount of interest due of $280. So cash collected then upon the maturity of the note was $14,280. $14,000 for the note itself, $280 for the interest that was due on the note as well.